Welcome to Taking Stock for the week ending the 17th of September 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to your thing share market. But before I begin, I want to let you know that we won't be recording a Taking Stock video next week, and that's due to the Victorian Football Grand Final holiday. But feel free to contact us if you have any questions with stocks or on using Stock Doctor. Now, in our previous appearances, we have alluded to our positive disposition on the market for the year ahead, especially on the back of rising vaccination rates, the continued central bank stimulus measures, and of course, low interest rates. Although the market is anticipating interest rates to rise from 0.1% to 0.25% by the end of 2022, as specified in the chart on screen, the RBA believes this will not occur until at least 2024. And this is because lockdowns have meant wage inflation remains weak, meaning interest rates can only rise if inflation rises sustainably within the RBA's 2 to 3% target band. Regardless of this though, low and rising interest rates tend to be positive for equity markets anyway, because interest rates are a function of rising economic growth.
Yeah, meanwhile, some of our income investors have been concerned about the rapid decline in iron ore prices and what this means for the likes of BHP, Rio Tinto, and Fortescue, currently in our star income stock universe. Iron ore prices have fallen as China curbs steel production, especially in the Yunnan, a southwestern province that produces around 2.3% of China's total crude steel output. Illustrated by the red line on the chart on the screen, volumes have fallen 8.4% in July from a year earlier, with similar trends being observed in August. The downward spiral has been exacerbated by the country ramping up pollution controls in preparation for the Beijing Winter Olympics. As such, we are cautious with the forecast dividend yields for many of these miners and believe that the consensus dividends on Stock Doctor are slightly optimistic, especially with Fortescue Metals. The expected decline in free cash flows in FY22 could potentially impact dividend payments, though despite this, even if dividends were to be cut by 50%, the dividend yield on these miners remains well above the market average.
So income investors will need to reconsider your exposures in those volatile resource stocks. And even though reporting season has ended, our team has been busy scouring the ASX for potential star stock opportunities. You would have noticed that there's been a higher than usual volume of star stock movements over the week. But rest assured, if a stock transitions from star growth stock to borderline star growth stock, this doesn't mean that the fundamentals or the financial metrics on the business has changed. Rather, it is the result of us beginning our transition process towards a more optimized star growth stock model. From a portfolio management perspective, it would make sense for you to hold on to these stocks if the fundamentals haven't changed and it still meets your investment objective and risk profile. Of course, you can still contact our analyst to help you understand the business if you are unsure. Let's now move on to some of our star stock highlights for the week. A star growth stock we believe represents opportunity is Brambles. And Brambles is a supply chain logistics company that outsources returnable pallets, crates, and containers. The stock was sold down heavily after it signaled that its earnings for financial year 22 would grow by about 1 to 2%, and that's well below market expectations. This short-term setback in earnings expectations is the result of increased capital expenditure on transformation projects towards digitization, and this will improve the operating efficiencies and profit margins from financial year 22 onwards, leading to stronger earnings growth in these years. As a result, we believe the share price weakness will be temporary.
Yeah, meanwhile, Commonwealth Bank was recently initiated as a borderline star growth stock. Investors might be wondering why this bank and not the others. Well, Commonwealth is considered a high quality bank amongst the banks, and this is reflected by its superior return on equity of 12.1%. Its net profit margin is also the highest at 30.1%, and this is due to its stringent cost control and management of bad and doubtful debts. Commonwealth Bank is currently on a forward gross dividend yield of around 5.4%, which is below the other majors due to the quality of its loan book and lower overall risk profile.
Yeah, however, Jake, investors need to be mindful that the other banks will be reporting their results in November, and we expect to see an improvement in their financials as well. So some of these banks may also come into our star growth universe of stocks. Before investing in a bank, It would also be worthwhile to look at other core bank metrics, including the capital position they have, that's represented by the Common Equity Tier 1 ratio, the net interest margins, the cost to income ratio, and also the bad debt metrics like the one you see on the screens here. But these metrics will be updated at the end of the following bank reporting season.
That's right, Kien. And look, over the week, we also introduced two more retailers, Super Retail Group, SUL, as a Star Growth stock, and Premier Investments, PMV, as a Star Growth stock as well. Super Retail Group focuses on auto parts and outdoor accessories with brands like Supercheap, Rebel, and Macpac, while Premier owns brands like Peter Alexander, Just Jeans, Portmans, and Smiggles. Those concerned about having too much exposure to retail in their portfolio should consider diversifying into other star stocks. This is why we have circa 76 star growth and income stocks to provide an ample opportunity set for our members to select from based on their risk tolerances and investment profile. In addition, investors should note that our quantitative stock selection process naturally gravitates towards companies that demonstrate high levels of profitability and growth irrespective of the economic environment, and retailers currently benefiting from government stimulus and high consumer savings rates.
Yeah, that's right, Jake. But looking ahead, though, earnings growth for many of our star retailers are expected to revert this year because of the growth rates that they've experienced. So they're coming off a high base. However, we do feel that the dividend profile for retailers like Super Retail and Premier Investments are sustainable, even with the anticipated fall in free cash flow this year, because there is a surplus margin of free cash flow above dividend payments. Currently, the gross dividend yield for Premier is at 4.4%, while Super Retail has a more attractive dividend yield at 6.8%. As a side note, Premier is set to report its full year results next week on the 23rd of September 2021, and consensus suggests it will continue to meet our star growth criteria.
Yeah, and Kim, we've got an interesting one this morning that's a bit hot off the press. EQT has walked away from its proposed takeover of X-Star stock Iris, and that was highlighting a key takeover active risk we did speak about in our exit commentary in August following the first half 21 report. Now, turning our attention to our corporate calendar, Premier Investment will be reporting next week, Suncorp will be hosting their AGM, and Cochlear will be going ex-dividend, all on the 23rd of September. To technical alerts and for trend-sensitive investors, Pushpay turned bullish on the SD Max, that is the Stock Doctor moving average crossover, while Cochlear, Integral Diagnostics, Jumbo Interactive, and Netwealth turned bearish on the SD Max. On the SD30 TSR, the 30% stop loss, both Fortescue Metals and Evolution Mining signalled an exit.
So for Under the Microscope this week, we want to look at two salary packaging and novated leasing companies, which were included in our Star Growth stock and Star Income portfolios this week. Smartgroup, SIQ, and McMillan Shakespeare, MMS. Both companies reported improving trends in return on equity, net profit margins, and they also both have very strong earnings quality. In addition, the outlook on both companies is rosy, with earnings expected to be driven by employment growth, new vehicle sales, and also the outsourcing of fleet management by corporates. As service businesses, both companies command healthy profit margins and strong cash flow, allowing them to pay attractive dividend yields. Between the two, McMillan Shakespeare has a more attractive gross dividend yield of 7.4% compared to Smartgroup at 6.7%.
And to help our investors decide which stock is suitable for them, let's highlight the differences between the two. Smartgroup trades on a lower dividend yield and higher price to earnings multiple because it has a more robust growth profile. It also has a stable government sector client base, including the Department of Defence. The company generates 80% of its first half 21 revenue from salary packaging and novated leasing operations. Meanwhile, McMillan generates 42% of its FY21 revenue from salary packaging and novated leasing, while finance broking represents the lion's share of the group's revenue at 47%.
But before making an investment decision, investors should understand that the biggest risk to these stocks is the potential changes to novated leasing and fringe benefit tax laws. For example, the threat of legislative change contributed to a 50% fall in the McMillan share price in July-August 2013. And as we head into an election year, this risk might surface again. And of course, another risk includes the potential for contract losses as well. So we'll keep in mind of these risks.
That's right, Kien. And also, the management of Smartgroup has more skin in the game, with the CEO and chairman holding roughly about 1 to 2% of stock on issue.
On the back of bubbly markets and a healthy appetite for merger and acquisitions from both domestic and international players, a number of members have asked us how Stock Doctor could be used to screen for potential takeover opportunities. Well, it's really more an art than a science to identify which company is right for takeover. Using Stock Doctor's powerful filter tool, here are some of the broad characteristics to look for when searching for potential takeover targets.
Firstly, select Build a New Stock Filter in the Stock Filter screen found under the Tools menu. Select the GIC sector classification on the right of the screen that you want to be included. Some of the sectors are more prone to M&A activity than others, but in this section you'll drill down on the areas of the market that you are interested in. For example, here we can remove the resources and REITs.
Yes, and next add in the filter criteria. To avoid buying into a company at risk of corporate collapse, select financially healthy businesses. Acquirers tend to look for companies that have strong balance sheets. Either they have a net cash position or manageable debt on their balance sheet. But note, in a low interest rate environment like today, acquirers are not very sensitive to this metric because the cost of debt is low. That's why we're seeing companies like Sydney Airport and Afterpay being subject to takeover as well. Another filter you should use is valuation, because acquirers also want to buy at the right price. Here you can use the price to earnings ratio or the price to consensus target, but we prefer to look for companies' returns, say, less than 20% over the last year.
The following criteria could be the company size measured by the market capitalization. Smaller companies tend to have more potential buyers than larger ones. So here we specify a market cap of less than 1 billion. You can also add in other fields you are interested in and run the filter.
Hopefully that gives you some insight into using this filtering tool, but thanks again, Jake, for your valuable insights today.
Thanks for having me on again, Kien.
So as we look for new star stock opportunities, it's important for you to review our commentary, the active risks, the share price trend, management track record, and principal activities, the golden rules to ensure you are comfortable with the investment. And income investors need to be careful in relying on those overly optimistic dividend forecasts for the bulk commodity miners, especially when iron ore prices are coming down. Once again, a reminder that there will be no taking stock video next week due to the Victorian Grand Final public holiday. In the meantime, take care and have a happy, healthy, and prosperous week, everyone.